Hi, hello everyone. Today I'll be talking about case 12, Heinz estimating the cost of capital in uncertain times. It's group 7 and let's start. The maturity of the notes was in 22 years and 2 years. The capital rate was 6.75% and 6.63% each year respectively, the price being 91.4 in 2009 and 116.9 in 2010. For 22-year note, the price was 116.5 and 113.7 respectively for the 2-year note. The yield for bond maturing in 2032 is 7.54% and 5.42 respectively for 2009 and 2010. The bond maturing in 2012 is 1.69% in 2009 and 0.97% in 2010. Moving on, the fiscal year of 2010 for Heinz, with an in-depth and analysis of Heinz calculation, we were able to generate a WACC of 6.72% for 2010. Their cost of equity was found by using the beta of 0.65 given. The risk-free rates of 3.69 for the year 2010 using the market premium listed as 6%. The WACC is the rate of which Heinz is going to pay its inventories, and average for interest-bearing security. Lastly, the risk in WACC from 2009 6.23% to 2010 6.72% shows inventories and opportunities cost for taking a risk with Heinz. Moving on to fiscal for year Heinz 2009. With an analysis for Heinz, we were able to generate a WACC of 6.72% for the previous year 2009. This is higher than 2010. This indicates a higher level of risk for 2009 due to the economic recovery and job growth. Regardless of the product price increase, 2009 was still a profitable year. Moving on for WACC for Kraft food. Weighted average cost capital is calculated by multiplying the cost of each capital source and debt equity by relevant weight and then adding the products together to determine the value. First, we have Kraft debt at 18,990 million. Next, we have the market value of equity at 51,800,000 million, calculated by multiplying the share price of 29.90 by the value outstanding shares of 1,735. The total capital is the company debt plus its market value, which equals 70,867. Next, we have the weighted of debt and weight of equity, which are 0.6, 0.267 and 0.732 respectively. For the cost of equity, you take the risk-free rate of return and add it to the product of the beta times and difference between the market rate of return and risk-free rate of return. This gives Kraft Foods cost of equity of 7.361%. The cost of debt after tax is simply calculated by taking the given cost of debt 5.12% and multiplying it with 1 the assumed tax rate. This gave Kraft Foods an after-tax debt cost of 3.328%. Now the formula for the WACC can now be computed. Taking the product of the weight of debt and cost of equity and adding it to these given Kraft a WACC of 4.41%. Now moving for WACC for Campbell Soup Company. The debt of Campbell Soup is 2,624 million. Its equity is equal to shares outstanding times share price, which is 363 times 35.64, which is equals to 12,937.32 million. So the total capital that is equal to debt plus equity is 15,561.32 million. Thus, the weight of the debt that equals debt divided by total capital is 0.1686. Then the weight of the equity is equal to 1 minus weight of debt, which is 0.8314. And next, use the formula cost of equity, which equals RF plus beta times RM minus RF. It can be calculated that the cost of equity equals 6.85%. As we can see from Exhibit 4, the cost of debt of the company is 4.36%. Assuming tax rate is 35%, so the cost of the debt after tax is 2.834%. Finally, WACC for the company equals weight of debt times cost of equity plus weight of equity times cost of debt after tax, which gives us 6.17%. Moving on for WACC for Del Monte Company. Similarly, we do the same for other two. The weight of debt Del Monte is 0.3193. The weight of the equity for Del Monte is 0.6807. Then the cost of equity for Del Monte is 7.9%, and the cost of debt after tax is 4.0324%. Thus, the WACC equals 6.66%. Finally, the WACC for Heinz shows low WACC, so more project can be approved and taken by Heinz. Heinz showing big changes in the stock price, so cer- it cannot certain if the WACC should be changed or not. The company cannot be sure how customers will react due to the changes of the economy conditions. Last but not least, the company should improve to reduce WACC to get better returns in future. That's it, and thanks a lot.